Coming up on today's show, the 10 biggest risks to the market in 2025. Is the Santa rally still on, or have we pulled forward all of the gains? What I see the market doing in the first quarter of 2025, and market sentiment. What are things looking like under the hood? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks were little changed on Thursday as trading resumed after the Christmas holiday, and markets kind of look to be struggling in a bid to extend the start of the Santa Claus rally, which kicked off with a bang on Tuesday as the S&P 500 notched its best Christmas Eve performance since 1974. And guys, it was simply that. It was very mixed trading across the board. ABGO was probably one of the best performing stocks, up 2.59%. And we saw pretty much flat trade from the other big guys. Nvidia, Microsoft was literally flat on the day. Apple gained a little bit. Amazon fell a little bit. Tesla was down 1.19%, the most of the Magnificent Seven companies. And all in all, it was just a mixed day across the board. The S&P 500 pretty much flat on the day, slightly up. XLK up 0.27%, the best performing sector, but a very light day of volume and a light day of trade. XLRE up 0.23 as well, followed by staples, financials, industrials. It was a very mixed day. There were cyclicals, rate sensitives, growth, defensives leading at the top today. And then we also saw much of the same here for those that declined. Not really any sort of a trend to take off from today, other than the fact the market is likely digesting some of the low volume we're seeing today, as well as the gains we saw earlier on in the week. It was a positive day net. Mid caps gained, large cap gained, all except large cap growth. But the real standout winners today was actually small cap across the spec. Small cap growth, value, core outperformed their mid cap and large cap counterparts everywhere. It really was a day for small caps, which is really, really good. And broadly speaking, when you look at the market as a whole, we had 2,400 decliners, 3,700 advances. So market breadth underneath the hood actually gaining against what has been pretty terrible market breadth in the last week or so. And then when you actually look at it, you could see that compared to last week, 7% of stocks above the 5-day moving average, that is now above the 80% mark. That is good because that means we can now go ahead and take the 20-day, then the 50-day. We actually did go ahead and also recapture the 100-day relative to Tuesday. So we lost it here on Tuesday, regained it today. That's very, very solid. So these longer term trends continue to remain intact. And that is why I've always said in this dip we saw in early December, you want to buy that dip. It was about a 4.5-5% dip, and those that did buy the dip have been rewarded because the S&P 500 is virtually now positive in the month of December. But there's still some work to be done with some of these shorter term and medium term averages, particularly the 20-day and 50-day. If we go ahead and retake these averages, then it's off to the races for the rest of the Santa Claus rally. However, a lot of work here to be done, but we did see incremental improvements from Tuesday to today, relatively speaking, and that's always a positive development. If breadth improves across the market, you love to see that, especially in a flat day like today. However, even though we had very positive breadth, what really weighed the market down was Tesla. It was down nearly as much as 2.5% on virtually no news. I think it was just digesting a lot of the price action. Since the election, Tesla is up nearly 140%, and that really made it difficult for the markets to rally. This is like a $1.2-1.3 trillion company now, so it really does weigh on the market. Just a couple of months ago, this was like $400-500 billion company, so we didn't have the same weight it has now. Bitcoin also fell, so some of these Trump trades didn't do so well today, but again, digesting all of the gains they've seen this year. Tesla was up big year to date, so too is Bitcoin, and we did see a little bit of a pullback here, and that was from the 100,000 mark, or just under the 100,000 mark. So a pretty big pullback, 3 or 4%, all things considered. And in light of everything, there wasn't much data to go off. Weekly jobless claims and continuing claims was the only data prints that we actually got today that mattered. Weekly claims fell to 219 1,000 compared to the expectation of 224. We also saw positive revisions compared to last week, and then continuing claims pointed to a cooling labor market jumping by 46,000 in the week this week to 1.19 million, and the consensus was for 1.88 million. So a slight miss, but inconsequential really. And then we also had just a couple of auctions, the 4-week, 8-week, 15 and 30-year auction. And guys, looking at the charts, you can see that yields, the 2-year yield and 30-year yield gained ever so slightly after those bond auctions. The 10-year yield fell, so fairly mixed price action in the yield market today. The dollar was flat, so too was bonds. And then with all that price action, we actually saw gold and silver, precious metals, gain quite a bit. Gold actually outperforming the broader equity market, as well as Bitcoin falling 3.88%. And then looking at equities, we see very muted action in the large caps. Small caps, the IWM, the Russell 2000 outperforming, up 1.2%. Very positive day. And then we see stuff like the RSP outperforming the larger names, up 0.25%. Mid caps gaining, and S&P 600 in the fold as well, but not quite as positive as the IWM, which is just generally higher beta. And if we actually look at the S&P 500, this is the SPY month to date, virtually flat. You can see we're down 0.21%. And if we actually take it on a peak to trough basis, right, we could see that the S&P 500 fell nearly 4.6% on a peak to trough basis. So we've seen a very positive move to the upside after the hawkish pause we got from Jerome Powell at the FOMC. So to actually see we're kind of flat here in the month of December is actually incrementally positive. If we actually go ahead and add some of the other names, let's look at the Qs. Let's add the IWM, the Russell 2000. Let's add the S&P 500 equal weight and see what shows up as well. And you can see that the Qs are the best performing sector here, up 3.21%. And then the IWM and the RSP not having a good December. So even though we did see quite a bit of outperformance here on Friday by something like the IWM and the RSP, the place you definitely wanted to be was the larger cap names in the month of December, particularly the Qs, because they really just delivered extreme alpha, relatively speaking. However, let's actually remove these and hop onto the S&P 500. Let's look at the daily chart just to see where we stand. And yes, guys, technically speaking, we did put a lower low right here relative to this low. However, it was at the put support. We then rallied right back up. And generally, guys, I was saying buy the dip right here because I said if you buy the dip and we get back into positive gamma, that probably means we go back to these highs, back to the core resistance. That's probably what we're going to do. We're probably going to see slight move up in the center rally to the core resistance. We're probably going to go make one more all-time high to cap off what has been a fantastic year in the equity markets. And we are in positive gamma. For those of you that don't know, above this yellow line, the gamma flip, we're in positive gamma. Below, we're in negative gamma. And in positive gamma, the markets generally do this type of price action. They buy dips, sell rips, and we have a bullish tilt. In negative gamma, we see quite volatile price action. And what we really look for is dips to get long. That'll take us back into the positive gamma. And then we can go to the core resistance. And normally what we see is we take out those highs. So in positive gamma, we want to remain constructively bullish. And that's actually what we're seeing right now. So don't be surprised. We have market momentum for this year, and now even in the month of December after this low, this was just a dip buying opportunity, and we probably will go ahead and take out those highs in the S&P 500, in the Nasdaq 100 too. In fact, the Nasdaq 100's high is at this core resistance, so there's quite a bit of confluence right there. And then in the RTY, we saw very positive momentum. And guys, if you go watch the weekend video, we said a couple of things. We said for this week, what we really want to see is the S&P 500 and the Nasdaq 100 get into positive gamma. That's what we saw. And we want to see the RTY get as close to the gamma flip as possible. That's exactly what we're seeing right now. And look, if that happens by the end of this week, over the next couple of trading sessions, into next week and into the first week of January, we can then see positive momentum here in small caps and the broader market. So right now, from what I'm seeing in the market, this is setting up to extend this rally into the first week of January, but that is contingent on the S&P 500 and the Nasdaq 100 holding their positive gamma levels and the RTY actually getting to the to the gamma flip buy this week, and then maybe even retaking it, having some price action in positive gamma. That's what needs to happen. And then we should see the rally continue into the first week of January. But in the year and now, if you haven't bought the dip, this is probably the last dip you would have gotten for the end of the year. I doubt we're actually going to get another dip in the S&P 500 and the Nasdaq 100. And if you're looking to maybe get on board this rally to ride the Santa Claus rally, I'd look at something like the RTY or the RSP, the equal weight. By the way, I do think we're going to see the highs in the equal weight probably before the inauguration on January 20th. So that is going to happen. So alpha can be found in the RSP or the RTY looking ahead, the Russell 2000. However, you still want to ride the overall momentum we're seeing in these large cap names. Don't fade them. So many people were getting ready to fade these large cap names into the start of December, and that was not the right call because they really did outperform, relatively speaking. My advice, you should already be long, just hold the line and let's eke out these last bit of gains before the end of the year, before we talk about material downside. And for those of you that missed the S&P 500 and Nasdaq dip, look to the RSP as well as the Russell 2000. And let's talk about sentiment. This is the weekend poll. And this week I asked the question, how are you guys feeling about mega caps, the Nasdaq 100, the big tech stocks? What's your sentiment like? And 63% of you guys said you were bullish. Only 24% were bearish. And the thing is, guys, during this time of year, with the rally we've had, bullish sentiment literally drives stock prices higher. And then more investors buy in, expecting future gains. And it's just like this reinforcing circle where sentiment drives price and price drives sentiment. And this creates immense upward momentum, reinforcing the rally we're seeing right now, and especially during this time of the year, which is one of the strongest seasonal periods of the year, particularly the next 7 days. The Santa Claus rally, which is the last 5 trading days of the year, as well as the first 2 days of the new year, we see very bullish momentum in this period. 1.36% in average returns, 1.35% medium. 87% of the time we are higher, and we see the majority of the gains actually come here in this new year period, particularly on the first day of the new year, up 0.86%. Very, very bullish. Nearly half of the gains are on that day. So guys, you don't want to fight the trend. You don't want to fight the seasonals right now. You don't want to fight the sentiment. You just want to ride the wave that's coming, because a time to sell and a time to buy lower definitely will come. Because if we look at seasonal trends in the first year of a US presidential cycle, the S&P 500 average trend has been down from February to April, and then we saw a rebound from April into August. So you could see here in the first part of January and February, we see pretty much flat trade, slight bullish momentum owing to the Santa Claus rally in part. Then we actually see a little bit of a pullback as the new administration gets their policies going. What we then see is actually a dip, sort of like a double bottom here. We tend to see a higher low, and then from there, we actually begin a rally from about the April period all the way to August, where we actually then put in a top, and then we actually see very vicious downside in the first year of the presidential cycle. Now, will we see that? It's yet to be seen. However, what we are going to look for in the first quarter and potentially second quarter of 2025 is a dip, a correction. I'm thinking something in between 10 to 15%. I think 15% at max. It's definitely going to spook the market because of the type of momentum we've seen in this market. It's going to feel a lot deeper than that. However, it's going to be in between that 10, 12.5, 15% range. It's going to be a dip buying opportunity as long as the fundamentals are intact. And we could see for Q3 earnings looking very solid, up 9.1% versus the analyst expectation of 4.7%. Margins hanging in there as well. Revenue growing above analyst expectations. And this is the majority of the S&P 500 have reported. 496 companies. And guys, in the past, we rarely had a setup where the Fed is cutting rates, earnings are growing, we have deregulation, tax cuts are coming, and we're on the precipice of a technology boom. The only other times we can compare today's macro and technological environment is 1923 and then 1993. And in both those instances, we saw deregulation, tax cuts, and a technology boom. And we know that the roaring 20s and the early 90s was some of the best time periods ever to own stocks, to be long equities. And this is why we want to look for dips, take advantage of dips, because the next 2, 3, 4 years in this bull market is going to really reward investors, particularly for those that are in stuff like the tech names, the Nasdaq 100, the Nvidias, the Metas, the Googles of the world. They're really going to drive the rally forward. So guys, you want to buy the dip in quality stocks and let deregulation, tax cuts, and the market do its thing. And also backing all of this up is a favorable macro environment. Growth for Q4, Fed's GDP now looking solid above the 3% mark. Any growth above 3% is solid. We see employment. Goldman predicts monthly non-farms at about 150,000 for the year. And we do see hiring slowing down below the break-even hiring pace at the back end of the year, but it's really hard to forecast that into the future. Expect revisions as we continue into 2025. But in the year and now, they actually see hiring to continue to remain robust and the consumer to continue to have buying power against the rate of inflation. Real income growth is expected at 2.7% as PCE and CPI continue to fall, and this is across all income cohorts. However, guys, there are risks to this market, and Apollo Research came out and said these are the risks to the global market in 2025. Some are good, most are bad, but these are the risks. Tariffs, 90% chance of that coming through. Nvidia disappointing earnings through inflated earnings expectations. I think that's a big risk, especially as we see companies like AMD, Marvell, Broadcom come into the picture, especially in the data center space. They see the US economy re-accelerates and animal spirits come back in. There's an 85% chance of that. That's bullish. M&A and IPO activity rebounds. That's bullish at 75% chance. The Fed stops talking about R-star, 70% chance of that happening. US inflation accelerates in Q1, driven by a stronger economy, tariffs, restrictions on immigration, and seasonal factors. 40% chance of that happening. That's huge, actually. That could really upset markets in a very big way. The pullback we're looking for in the first quarter, it could be really driven by one or all of these things: tariffs, immigration, seasonal factors. The Fed raises rates in 2025. Man, we're going to have to see inflation tick up in a very big way for that to happen. But Apollo pinned it at 40%. US 10-year interest rate moves above 5% before the mid-year, 40% chance of that happening. That would really devastate markets. The markets do not like hiking rates. Probability of a recession in Germany, 40%. China outright recession in 2025, 33%. US recession, 0%. So the US is where you want to be. And a fiscal crisis in the US, 10% of that happening in 2025. So these are the risks and rewards in the market. The macro backdrop looks good. The fundamental backdrop looks good. But there are risks we do need to be aware of. However, guys, never forget the market loves to climb the wall of worry. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.